Jonathan Camarda. New month, let's get rolling here in May. All right, so a lot of news to go over. First thing, GDP number came below estimates there of 2%, came in at 1.1%, as we are now looking at stagflation. So you're probably hearing it out there. We've mentioned it as well. And for those of you not cognizant, stagflation is essentially when you have stubbornly low unemployment numbers, non-existent growth, but yet inflation continues to be an eroding factor on purchasing power. Beautiful situation, right? And so from 73 to 81, we saw this. Markets tend to trade sideways during these environments, but stock picking becomes pretty important. And we'll get to that in a second as well, as far as being surgical in that situation. Now, we talk about market levels, estimates of where we are, a few different estimates coming in, but 3,800 to 4,200 seems to be the range based upon earnings multiples that are being looked at by analysts, CFAs, and these large institutions. We're at 4169 ballpark on the S&P 500 with today's obviously vacillation factored in there. And so how much upside do we have? Well, that is on the earnings multiple side, which is more on the fundamental side. However, on the other side, large institutional money managers are putting a lot of money to work. Most active managers institutionally have been mostly cash all year. And so they're starting to buy stocks as well, which is what happens when markets go up. So again, I know folks look at obviously the money market, treasury obligation, Federal Reserve, SNOCs, 4.5% yielding ballpark positions here, and sometimes wonder, well, the market's up, you're not all in. Most large institutions are even slower to get out of bed there, in movements with when markets are going. So you're seeing a lot of money starting to move in. So that could be an upward, trend as well for markets. Also, a large amount of institutional put options are out there. That means that they've been selling the market, and if we continue to see strength, that could be what they call short selling, covering, right? They got to cover their shorts as the market moves higher, which automatically adds more juice to the upside. Another positive for the market right now as well is that we have over 50% of S&P 500 companies now trading above their 10, 50, and 200-day moving averages, which again is a positive trend. Now that being said, some of the positive stuff, earnings been better than expected. 53% of the companies have reported, and 79% have beaten their earnings, their EPS estimates, and 74% have beat their projected revenue numbers. However, again, remember, some of these expectations were based upon downward revisions of the recent economic malaise. Now, getting to the Fed, batting like 6th or 7th in the lineup here, right, with all this other stuff. But the Fed, I think it's presumed we're looking at, of course, it's this week, right? Get ready for Jerry. Get the popcorn ready. Facetiousness aside, probably looking at 25 basis points. I think is already factored in, at this point. And then many think that they are done. Of course, many economists out there are Pollyanna, thinking that the recession is going to be soft landing. No, nobody knows. We are in a recession. We've started a recession. The bond market knows, and the bond market's been saying this for a while with what they call an inverted yield curve, which we've already gone over in the past, and that's all recessionary. The jobs numbers are obviously pretty gilded, right? We have thousands and thousands of layoffs by companies, but yet sticky employment. Well, when you factor in part-time, I guess it pretty much is. Now, with the Fed's 25 basis point hike this week projected, then ceasing there to see again where we move. And a couple of things on that. We just saw, usually I don't get into companies, but since this is news, First Republic, FDIC came in, and of course it looks like JP Morgan, parachuting Jamie Dimon there to the rescue with almost a cat who ate the canary grin, as many think that the JP Morgan's kind of underplaying how good this is going to be for them. I'll leave that at that. From that standpoint. But obviously, many also have said, well, the banking situation is all settled now because these were all idiosyncratic. Between your SVB, your First Republic, they all had idiosyncratic situations that are not systemic. However, there are a lot of loans. We saw our Uncle Charlie Munger this weekend, woke up there from a slumber and very adroitly pointed out that there's a lot of commercial real estate loans on banks' books that not attractive. Now, we've also told you, 1.5 trillion coming due in commercial loans over the next couple of years. You have office buildings being vacated Owners of office buildings going into bankruptcy because companies are moving out post-COVID, the change in work culture, as well as the shifts, of course, from certain cities, out west. Certainly, there's been an exodus. San Francisco, usually the venture capital of the world. It's now Austin, Miami and Austin now. Miami's given Austin a run, in fact, maybe surpassing in some ways by the influx that we've seen. As San Francisco is just, I don't say it's a ghost town that way, and there are those that still defend the Golden Gate allure, but that's really just an almost legends annals only. So off of that migration, what are we talking about? Real estate-wise, again, from a real estate standpoint, slowing home sales, of course, we've seen that, and then you start to see building permits growing as well, and with a slowdown of where, again, things kind of come to a halt. And as we go into a recession, it's going to be more and more interesting. Again, mortgage rates still not attractive enough to cost people that are paying maybe low single digits to mid to upper single digits, so they're staying put. So again, you have a very slow, movement there as well. So as we get to markets, S&P, NASDAQ, Dow Jones could also all glide to the upside here until the weakest of them all, which is not a positive, the Russell 2000, hits up against a certain level, and then we could see resume selling here as we go into the sell in May season. And of course, we have the debt ceiling situation again. That's a soap opera figuring out. Well, bill's been approved on the House, going to go to the Senate. I'm being a little glib here, but who knows, right? Who knows? We saw this in 2011, and the immediacy wasn't pretty. And then, of course, by the end of the year, things had recovered quite nicely. We don't know. So as we get to the strategies, certainly active capital preservation continues to play the long and the short end of the Treasury yield. Gold has been basically stuck in a little bit of a quagmire here, right? As we go into a recession, gold had a little bit of a surge with the banking situation, and we're not negative on gold. We still own some, but however, it's been a little bit more challenging there for the precious metals, so certainly keeping an eye on that. Now, in equity strategies like opportunistic growth and income continue to be fully deployed. Doing well. Also, All-Stars, we don't mention that enough. That's a smaller portfolio there as far as the concentration, but certainly a lot of clients like that juice in there. That's the 5 top stocks in NASDAQ, and that's been doing well, year to date as well, as you would think with NASDAQ. Now, that can go, again, to cash in any time as well, depending on market conditions. And then, of course, your ETF strategies, macro momentum comes out of its Treasury obligation holdings since the beginning of the year, and certainly bought in based upon a longer-term bull signal. But again, that's watched on a constant basis. And then sector momentum as well, getting into those more attractive sectors that we've seen on your technologies, materials, et cetera, as well, as we run this train into late May. And then, of course, reevaluations will have to be made. Global macro tactical, again, more of a tech lean there, and chips and as such you've seen, and then Velocity Raptor basically recalibrating back to its, again, sector strength ETF positions from individual equity positions as we move into late spring. So that pretty much covers all the strategies. Where do we see things? It is tough to see. As we move into May, usually sell in May, but there's still some momentum late April into May with all the criteria and all the circumstances we've been discussing. Earnings continues to chug along. Will it continue to beat expectations, albeit lower expectations? Debt ceiling, hey, stay tuned. That's all I can say. We'll see you next time, and certainly stay frosty, and we promise to be eternally vigilant. Again, Jonathan Camarda signing off. Talk to you soon.